Hi, this is Bennett Tchaikovsky. This is Owner's Equity Part 4. We're going to be finishing up our discussion today by talking about stock options. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. The opinions in this presentation are that of the author and the author alone, and not the opinions of the author's employers, including but not limited to Irvine Valley College and the South Orange County Community College District. The information contained therein is not meant to be any legal or accounting advice whatsoever. So the last topic we're going to be talking about here is our stock options. And this is something that I really believe is very important for companies, mainly because when I was taking accounting classes in ancient times before the empire, when I was taking in that long time ago, a galaxy far, far away at UC Santa Barbara, stock options were never, they weren't expensed. They were just, it was a disclosure. However, they have now they're now expensed. And the problem I have with it is mainly that it really can distort a company's earnings. And I'm not disagreeing necessarily with the disclosure, but at the same time, it doesn't reflect the amount of cash. There's no cash liability for stock options, meaning that when a company is giving out stock, or when it gives out stock options, there's really no cash component of doing it. And so it doesn't really hit the books. It's almost kind of a reclassification of retained earnings. You have retained earnings ultimately is going to be debited because that's where compensation expense is going to be closed out to. And then you have a credit to additional paid in capital common stock. So it's almost kind of like our additional paid in capital common stock is being grossed up. But again, this is where and we're going to look at Twitter in a second. And this is where kind of getting an idea in terms of, this is where accounting can go crazy. And this is a very important lesson for us that the more important thing about accounting is not necessarily if you're going to become a CPA, because you absolutely should become a CPA. It's really about knowing what goes into these financial statements. And so really right here, and also before stock options, before we talk about this anymore, these options are a way to incentivize, retain, and recruit employees. Options need to be priced on the date of the grant. You cannot backdate options. The option pool needs to be approved by the board of directors, and issuances should be approved by the board's compensation committee, especially for the CEO, CFO. And again, you want to follow the rules correctly because the SEC will jump on you in about 3 seconds. So it's not worth it. You should also, as a company, if you're dealing with publicly traded companies, you really need to have an insider trading policy because you don't want employees trading shares during blackout periods. And that's not Scorpion's blackout, but that's a blackout where because employees may have sensitive information that could, certain employees have information where it could essentially de facto insider trading. So you want to be really careful about how you do it. And I may have spoken about this in a video earlier, but if you are a CFO, don't do it. If your company is big enough, use what we call a 10b5 plan. But if you're with a small cap company and you're an officer of that company, you really just want to be buying shares during certain periods, but not selling. So that's a really important distinction. So after an employee is vested to perform the work and they're invested in their options, or even if they haven't vested, the company is going to use the Black-Scholes model to determine the valuation of the options. We'll make the following journal entry. And just for fun, because I know my awesome student Oliver is going to want to see this, I've kind of put up here, I found a Black-Scholes calculator. What this does is when you're trying to determine the value of stock options, you'll use this Black-Scholes model. There are a lot of them out there. This is what I'm using right here. There was one that I used to use and works well. You put in the stock price currently. What is the exercise price of the option? Most of the times when you're getting stock options, it'll say you can buy 1,000 shares at $15 per share. So we're going to put in that exercise price. If the stock price is trading at 10, we put in the exercise price. The time to maturity is when does that stock option going to be, I want to say, when does it actually go through and expire, or when does it mature? And then we're going to have an annual risk-free interest rate. I typically would use, it was one of the treasury notes. I would look at the long-term one to essentially tie that to the time to maturity. For example, if it was it was like if a 10-year maturity time, I would look at the risk-free interest rate, which is the daily treasury yield curve, to put in that percentage. The volatility is a calculated amount that you're going to have to go through and do for the stock, meaning how volatile or how up and down is that stock price going to be. Generally, the higher the volatility, the higher the option value is going to be. So very, very important that you'll go through and do this. Remember, as management, we're going to be making this determination here for the value, and the auditors are going to go through and check in our inputs. But again, this is management's assessment for my classes, for my financial accounting classes that are lower division. No way I'm making you do this. So if I do, you can like throw stuff at me and leave me more bad reviews on Rate My Professors. I'm totally down for it. So right here, let's take a look at Twitter and how this has impacted Twitter, because I love Twitter. Twitter's awesome. All kinds of crazy stuff happens on Twitter. If I look at Twitter's 9-month statement of cash flows for the year, for the 9 months ending September 30th and September 30th, 2014, what you're going to see here is when you have, so Twitter, for accounting purposes, was operating at a net loss for the 9 months ended September 30th, 2015 of roughly $430 million. But what was included in this net loss? $523 million of stock compensation expense. If we got rid of this stock compensation expense, this net loss would be actually a profit of about $93 million. So it's kind of important to and we can kind of see here, Twitter has made a huge rebound, not a surprise here. They made a huge rebound from the past year. But again, you look at these numbers, they were at a 9-month loss for September 30th, 2017 of $200 million. And that loss was mainly created by, depreciation we're not really concerned with, but look at this. This is just nuts. You got a $331 million stock-based compensation expense that all of a sudden now that company's profitable. So if I was Twitter, and I'm pretty sure that Twitter does this, you really need to go through and explain to investors. It's like, hey, bud, it's like right here, we're looking amazing. It's a stuff that financial accounting requires us to go through and record. So that's something that just to kind of keep in the back of your mind as you're going through here and looking at stock compensation expense. So I realize I probably should have made this video combined with something else, but of course I don't time it. But that is the end of the video here for today. I want to thank you for joining me, and please do not forget to like and subscribe. To like and subscribe. And like every other new to YouTube user, that's what I'm always going to be saying. And I'll see you on the next video. Thank you so much for joining me today.